Hello and welcome to the 2021 edition of the annual conference of the Green, Social, Sustainability and Sustainability-Linked Bond Principles that we now refer to more simply as the Principles. As in 2020, this is a fully virtual event and we are very grateful for the level of interest that you have shown with near 2,000 registrations. We hope that next year we may be able to revert to a hybrid format, allowing for meeting at least some of you in person. This event is taking place in the context of continued remarkable growth of the sustainable bond market that now stands at approximately $1.6 trillion globally. Issuance to date in 2021 is near $380 billion, up 20% from the same period last year. The market and its growth are underpinned by the guidance developed by the members and observers of the Principles with their elected executive committee with the support of ICMA. Our research shows that 97% of sustainable bonds issued internationally in 2021 reference the guidance of the Principles. This is a remarkable achievement for all involved. There continues to be more widely keen interest in sustainable finance from the financial industry, of course, but also regulators, policymakers, and civil society. This creates an environment where the guidance we develop needs to take into account complementary initiatives as well as regulatory developments in some jurisdictions. We have at heart to be as inclusive and as global in perspective as we can. We have important announcements for you today, and especially a new edition of the GBP, its first update since 2018. Over the last 3 years, this crucial document, translated into 24 languages, has been at the center of developments in the market as it has gone mainstream. The 2021 editions of the Social Bond Principles and Sustainability Bond Guidelines have been similarly revised. The event today will be organized around two panels. The first, that I will have the pleasure to moderate at approximately 15:45 CET, will focus on the Principles update and its interplay with other guidance. The second, at 16:40 CET, will look more broadly at the best practice outlook in a global sustainable bond market and will be moderated by Joanna Coe, Head of Responsible Investment, Zurich Insurance, and Vice Chair of the Executive Committee of the Principles. But before we go to the panels, I have the great pleasure of introducing our keynote speaker, Bjorn Sibbern, President, European Market Services at Nasdaq. I would also like to warmly thank Nasdaq for their sponsorship. Over to you, Bjorn.
Good afternoon. My name is Bjorn Sibbern. I'm President at Nasdaq here in Europe. Nasdaq is happy to support the ICMA and the annual conference on Green Bond Principle and Social Bond Principles. Today, I will focus on how we at Nasdaq look at sustainability and how Nasdaq is supporting our clients on the wider financial community. But I will start with briefly mention the last year's performance, which I believe have had major impact on what we call ESG. Over the last 15 months or so, European communities has met unprecedented challenges with a significant impact on the world economy. Stock exchanges experienced the strongest turbulence since the financial crisis of 2008. Out of our European headquarters in Stockholm, Nasdaq operates 8 exchanges in Europe, including the primary equity exchanges of Sweden, Denmark, Finland, Iceland, and the Baltic countries, as well as our markets for corporate and sustainable bonds. The purpose of the market is twofold. Number one, they create opportunities for companies, large and small, to raise capital in order to grow, invest more, create jobs, and contribute to increased prosperity. Secondly, they also give investors from private individuals to pension funds an opportunity to join a company's growth journey through secure, transparent, and fair trading in the case of Nasdaq, more than 4,000 companies. During the turbulent 2020, the exchange's role in the European society in which we operate has become even more important. For Nasdaq, our key focus during 2020 was to ensure that our market has been operating as normal through the periods of extreme volatility. Through our markets for sustainable bonds, we have been able to support both organizations, governments to raise funds to mitigate the effects of COVID-19. Yet another proof of how important financial markets are in the time of crisis. In 2020, we continue to see companies, governments, and NGOs looking to financial markets to raise capital to mitigate the effects of COVID-19. In the Nordics, we have, for example, seen the Nordic Investment Bank issue and list a bond with us to support the government of Estonia. Post-COVID, Europe's companies will more than ever need to rely on capital markets for financing their recovery from the effects of COVID-19 and to restart or continue their growth journey. We have also seen discussion about diversity spread across the world, and movements such as Me Too and Black Lives Matter have raised ethical discussions into management team, boardrooms of investment companies and corporates. Nasdaq continues to strive to be a key part of these discussions and to support the community in which we operate in. Just as one example, on the heels of our US board diversity efforts, Nasdaq also launched a Nordic partnership with the Albright Foundation with the ambition to raise awareness, engage in discussions, and educate companies and investors around board and leadership diversity. Fueled by the ongoing pandemic, I believe we'll continue to see the social aspects and the governance issues, S and the G, within the ESG concept to be more and more important. That being said, sustainability will, of course, continue to be an incredible important part, and early adjusters in the shift towards greener economies, such as the Nordic countries, will continue to lead transition to a more sustainable world. In the future, the demand for investment products and markets built around ways to make the world greener will continue to grow popular and increasingly professional. One such market is the carbon removal market, where we recently announced an investment in the Finnish startup company Pure Earth. Pure Earth is a marketplace for carbon removals and extends Nasdaq already large footprint within ESG service and products into another offering that will help our clients and support their transformation into more sustainable companies. As sustainability continues its transformation from add-on to foundation in corporate strategies, Nasdaq is focused on continuing to develop products and services that help companies and investors to make more sustainable decisions. In the years to come, we'll continue to expand our suite of products and services, catering to investors that, like we do, believe that the financial market has a large role to play in providing a better future for our planet and for the future younger generations. With its early rise to prominence, we at Nasdaq view the global market for sustainable bonds as a trendsetter and inspiration that other markets can take after. We launched the first market for sustainable bonds back in 2015. While the global market for sustainable bonds are still just a fraction of the total bond market, the growth has been astonishing, encouraging news for issuers, ESG investors, and our planet. Leveraging the knowledge we have gained in validating and operating a market for sustainable bonds, we recently took our first small step into providing equities the same seal of approval for green equities as we have ordered green bond issuers since 2015. Today's investors are increasingly linking a firm's ESG initiatives into its bottom line performance, a shift towards we now termed sustainable finance. As the market for sustainable investments matures, so does dollars returned for investors. What's more, according to Harvard Business Review, the stock price increases after an issuer announced a green bond offering, especially for those green bonds certified by independent third parties. In addition to offering companies an opportunity to invest in a more sustainable future, and issuers to raise funds to support projects benefiting the climate, affordable housing, employment generation, and other very important issues, exchanges can also play an important role in not just trading, but also providing investors with the data they need to be able to analyze and select their investment based on their investment criteria. Since 2019, the Nasdaq Sustainable Bond Network, for example, has grown into a leading data source covering more than 2/3 of all sustainable bonds in the world. By collecting, enabling comparisons of verified and comparable documents, data, and other quality of information, the platform offers investors an opportunity to invest in a more sustainable future, using high-quality data rather than software matrix, which was common in the early days of ESG investing. Numbers also tells a story of the benefits of what we all do. So far, bond issues on Nasdaq Sustainable Bond Network have raised more than $830 billion to projects benefiting our society and planets. And the number of people benefiting by social projects reported by the bond issues on the platform is 82 million. In a few days, Nasdaq will launch an enhanced and more investor-friendly board portal to provide greater access to all the amazing data generated by the incredible efforts made by all the sustainable bond issuers across the world. Thank you for your cooperation, providing investors with more purposeful investment opportunity and making the world we believe in a bit better every day. Thank you for listening. I urge you to reach out to us if you want to ask any questions related to what I've said or to discuss ways for Nasdaq to help your business.
Thank you very much, Bjorn, and thank you to Nasdaq. It is my pleasure now to open our panel, which is on the update of the principles and the interplay with our other guidance. Joining me on this panel, is Denise Zodaro, who is the chair of the Green Bond Principles and Social Bond Principles Executive Committee, and is also the head of investor relations at IFC. Welcome, Denise. And then we also have Joanna Kobe, who is the head of responsible investment at Zurich Insurance and a vice chair of the executive committee. And of course, Tanguy Claquin, who's the global head of sustainable banking at Crédit Agricole CIB and is also a vice chair of the executive committee. What I suggest to kick off this panel is, Denise, if you could perhaps take us through the slides that we prepared in order to give a quick overview of what is being announced today by the GBP.
I'd be happy to do that. So, ladies and gentlemen, it's my sincere pleasure to share with you the updates to the Green Bond Principles, the Social Bond Principles, the Sustainability Guidelines, and the supporting documents. Here on this slide, what you see is a list of changes to the updated principles published today. This is now the 6th version of the Green Bond Principles. And in all the time since the version 1 in 2014, the original objective of the principles has not wavered. The intent remains to encourage transparency, disclosure, and integrity in the development of the green bond then, and now of the sustainable bond market more generally. So with that in mind, the 2021 edition reaffirms the 4 pillars as the cornerstone of the principles. And that is the use of proceeds, you're very familiar with, the process of project evaluation, management of the proceeds, and of course, impact reporting. So this new version augments these pillars with the addition of 2 key recommendations. And those are that issuers have a bond framework and that they obtain an external review. Excuse me. There are also a few other important explicit recommendations made in this new edition, including heightened transparency for issuer level sustainability strategies and commitments. And what we're doing here is that we're saying that a thematic bond program should not be an ad hoc to an issuer's profile, but that the spirit of sustainability be evident at the issuer's enterprise level. Another update is that the principles now encourage the provision of information on the degree of alignment of projects with taxonomies. Then there's also an amplified recommendation for issuer processes to identify and manage environmental and social risks. Now, more specific to the Green Bond Principles itself, language is inserted to encourage issuers bringing green bonds to market for transition purposes, that they ought to use the guidance provided in the Climate Transition Finance Handbook that we published in December 2020. And finally, you will find in the annex of the principles a diagram with the overview of all the guidance provided under the principles. And we believe this visual representation will bring clarity as to the interrelationship of the products and their respective frameworks. And we'll go through that as well. I think we have one slide on that. Next slide, please. And so both the social bond principles and the sustainability bond guidelines exhibit the updates I just referenced. And to the largest extent possible, the Executive Committee aims to keep the use of proceeds frameworks consistent. And so you find the running thread through these are also what I mentioned, the 4 pillars and the key recommendations. And we can speak more about that strategy during the Q&A if so desired. But moving on to specifically to the updates here, I think you all are aware that this is the 4th iteration of the social bond principles. And the changes that were made last year in June when COVID hit, we acted very quickly to ensure that the SBP was clear in that it could be applied to socioeconomic crises that affect a target or general population. And what we've seen is the results speak for themselves, and we can also talk about that in the Q&A. And because of the changes we made last year, what you find this year is that the changes have been made to make them consistent, as I said, to the 2021 edition of the Green Bond Principles. So on this slide, you see that outside of the updated principles themselves, we've put together complementary documents that were also published today. And these include a pre-issuance checklist for social bond programs. And this is a document that gives guidance on the practical steps for establishing a social bond framework. And I'd mentioned earlier that a framework is now listed as a key recommendation in the new edition of the social bond principles. So another publication you'll find is the illustrative examples for the selection of KPIs for sustainability linked bonds. And this document comes with an accompanying table that really offers suggestions on how to identify, select, and to use KPIs to structure sustainability linked bonds. And we've seen this year, of course, about 3 times the issuance of sustainability linked bonds compared to last year. And we anticipate that this should further aid issuers contemplating this product. Also published today, you will find the guidelines for impact reporting databases. And here, this is guidance to these providers relating to several topics, including ethical standards, governance and data security, referencing impact calculation methodology, and so forth. In addition to all of these, of course, every year we make considerable efforts to ensure that the guidance handbook, which is the repository of questions and answers, reflects the changes we're seeing in the market and the work that's being done to address those. So that also has been updated. Now on to the final slide, please. So finally, as I'd mentioned before, the update of the principles includes this visual representation, which shows the relationship of all the documents within the principles. And of course, the principles being the cornerstone, and then the guidance being complementary. So here you see the family of products making very clear the categories of use of proceeds juxtaposed with the general purposes under the sustainability linked to the issuer level, of course. It also makes clear what the mandatory pillars are to be aligned with these frameworks and the key recommendations to follow. The diagram also shows how the Climate Transition Handbook forms an additional platform to credibly position the issuance of use of proceeds or sustainability-linked instruments to finance the transition of hard-to-abate sectors. So the overall goal here remains the same, and that is transparency, transparency, transparency. Transparency regarding disclosures so that investors can make informed decisions. And so with that, I think I'll hand back to you, Nicholas.
Denise, thank you very much. Now, I'm gonna turn to Joanna, and I'm gonna ask the obvious question. I mean, the key document we've updated here is the GBP. We hadn't updated it since 2018. It's been, it's been a pillar of the market. It's been translated in 24 languages. Why did we update it now?
That's an excellent question. Thank you, Nicola. And I'm sure very many people are asking that question. I mean, look, it does come fundamentally down to who we are. And Denise has just beautifully described that, right? The principles are an organization, a forum where market practitioners come together to give guidance to market practitioners for what? To really promote sustainable bond markets, to finance progress towards environmental and social sustainability. So that's our vision. It's parked in our governance. That's what we're here to do. And we do that through the guidelines and recommendations that we have in all of those documents that truly promote the transparency and disclosure. But the end goal, of course, is to, in a very integral way, channel funding to solving the problems that we want to solve. And in order to grow a market and really establish it, two things are necessary, right? We need to be at the pulse of time and be relevant, which is also an ambition that we have, to be the relevant organization to turn to. And that is very much reflected, as you have said in the beginning, Nicola, that 97% of sustainable bond issuance outstanding does reference the principles of some of the documents that we have. So we balance this stability, which we hadn't updated the green bond principles in a while because they are translated. Each of the documents we have are translated in between 10 and 24 languages. We have a variety of local regulatory standards and further recommendations based on them around the globe. And we have indices and further market infrastructure based on what we recommend. So we stopped updating for the sake of updates and keep things stable so the market can grow and develop. But at the same time, we need to be very aware of those developments and stay updated. And I think those are the main reasons. If we look back at 2018 and what has happened since then, we have seen the market grow tremendously, both for the green, social, and sustainability bonds, also the new sustainability-linked bonds. But in the use of proceeds market, lots of growth, lots of diversification in type of issuers, in the underlying topics of the use of proceeds that are being financed, in geographic reach, and that is really important. But what we've also seen is, while the principles based on that disclosure principle do allow for a lot of variety and also learning curve, we now have a very big cohort of best practice that has truly grown. And we can see today that the best practice very clearly are issues that have a very solid framework, which reflects their overall sustainability journey and can make sure how the use of proceeds fit into that journey, that are externally reviewed and that have an impact report. And I think what we wanted to do with this update is really make sure that we solidify and support this notion of where best practice truly stands today and signal that back to the market. Another very big development that we have seen is in the regulatory space and in taxonomies. While once that was truly at the fringes of capital markets, it's now front and center. There's a lot of activity out there to show what climate means, what climate transition means, what green means, and also sustainability in a broader space. Various national and regional taxonomies popping up, various standards popping up, a lot of regulation also coming up, very notably in the EU, but also in Asia and in the Americas. And given that we have such a global constituents, it's very important for us also to note that this is happening, to make reference to it and give guidance to the members. And last but not least, our membership has grown also tremendously. We now have over 400 members on observers. The executive committee, as you might know, is very clearly split between the three categories of issuers, underwriters, and investors in equal parts. The members are almost also equally split into those categories. And then we have a wide observership that form the broader market stakeholders, if you will. And we take their pulse every year. We have a consultation ongoing where we ask, is the guidance sufficient? What should we tackle next year? Because the ExCom works and the working groups underlying works in a multi-year program. And while in the past we have gotten signals to keep things stable, to allow them to grow, we have gotten quite a lot of signals. So substantive part of the membership has said we should really look at the principles again to take stock and how they fit into the regulatory development and that clear pushing forward of where best practice stands today, and to reconsider and to have a look at how we could do that. And those are the main reasons of why we did it. And we do hope that that's truly of help to the market.
Thank you, Joanna. Denise, Tanguy, do you want to comment further?
No, I think Joanna covered this, but one key point is, of course, that the annual consultation is how we, gather the I would say the roots of what we build out throughout the year. And I want to stress that, for us, the barometer is the spirit and the mission and vision of the principles in itself. If the document continues to be effective in that sense, vis-a-vis the developments in the market, then we stay true to it. We don't change things just for the sake of changing. And I think Joanna made that point very, very strongly. I don't know, Tanguy is...
No, I think you've summarized it very nicely. I just wanted to underline, in fact, this is the first update since 2018. And if we just take a step back and figure out where the market was in 2018, it was in a very different shape from what it is right now. And in fact, it's probably the right moment to adapt what we've done to all the market development that we have seen in the last 3 years. We have the chance to be in a market that grows very rapidly, but we see a number of new entrants, new players be interested in this market. And I think we have managed to make the change that makes sure that this text remains the reference for all the new players and new constituents that have entered the market.
Tanguy, that's a very good segue, I think, for a question that I wanted to follow up on with you. And for those that are listening to us, and also for the market, what do you think the key takeaways from the update should be? I mean, particularly from perspective of someone who is out there actually doing these transactions every day.
Sure. I think, as I said, I think the market has seen a number of developments in the last 3 years. I mean, new entrants. I mean, if you figure out 2018, we just had seen one or two sovereign bonds tapping the market. Now they are everywhere. A number of emerging market players enter the market, and municipalities in the US are more active also. We've seen a lot of different corporate sectors entering the market in green or social format, a number of public players in the social space. That's also true in the investor side, if you think about it. I think the development that we have seen with initially less sophisticated ESG player, like the central banks, for instance, is quite massive compared to what we have in 2018, which means also that the expectation in terms of transparency, in terms of formalism, has increased. And as Joanna has just mentioned, regulators are now looking at this market. Regulators in different forms, in different jurisdictions, are looking at this market. And in fact, they have a very strong influence on the way we see that. And so it's true that with that in mind, the text that is the reference for all of us had to take that into account. What are the changes? I mean, for most issuers, it's not a big change because the green bond principles have evolved towards recognizing a number of market practices that we were already all applying to some extent, that were already between the line of the text, but they have made it more explicit. And I think that for most issuers, that will be a confirmation of what they are all doing. But I think there is a lot of value in confirming those things for all the players which enter the market. So in fact, the most important element certainly is the creation of those two recommendations, one for a framework and one for the external review, which were mentioned before. Those are two elements that are really widely applied in the market. Having a framework and having an external review is something that we see in many, many cases. They are not new pillars because it's another way to look at things. Somehow the framework describes the 4 pillars, or an issuer follows 4 pillars. A review also looks at the way the issuer is following those 4 pillars. So it's a different dimension. It's recommendation because, in fact, we also need to recognize, as a text that is applied everywhere in the world, that there are some places where it doesn't apply, and there are some places where the framework is in the bond documentation. There are some issuers which do have a specific view for external review, a capacity to have independent verification. So, in fact, there are some areas where it doesn't apply, but nevertheless, we see that it's widely used in the market. And it was a bit like a missing element of the green bond principle. So that's good that any newcomer to the market would look at the text and understand, as he will see in many transactions, that there is a framework or an external review, see that in the green bond principle, it's clearly mentioned at the right position and with the right rule. Another very noticeable change that we would do, is actually in the second pillar. If you look at it, if you do a compare between the 2018 version and 2021 version, and you just look at what are the most important changes, they are in the second pillar, in the process for evaluation and selection, which is traditionally maybe the one that people understand less than the others. In fact, there are here some recommendations related to the issuer disclosure on sustainability. Those were things that were already in the air somehow. Those were things that we were all applying as underwriter when we're discussing with an issuer, discuss, of course, of how the bond is positioned vis-a-vis the issuer practices, but now it's more clearly mentioned. We also encourage the issuer to reference taxonomies, be they public official taxonomy or market-based taxonomy, but there we recognize and we encourage issuer to make the link between their green bond or their green bond program and taxonomy. And I think it's a very important move because it's some other recognition at the green bond principle level that the definition of what is green is somehow outside the principle. It's not completely outside the principle because we give some guidance about the green project categories, but somehow we recognize that there are taxonomies outside the principle that provides more detail about this. And it echoes the discussion that we have with the initial author of the principle back in 2013. We are not here to define what is green because the market players have all vested interest in this market. And it's not our expertise. We have a view, but it's not the expertise. So in fact, encouraging issuer to make reference to taxonomies, recognize this initial intuition that we had, and also clearly recognizes the development that we see in the market with a number of economic areas or countries starting to establish their taxonomies, which is also a very interesting tool for investors in order to compare the trades. And I think also a very interesting tool because I'm an optimist, and I think it will converge, those taxonomies will converge over time. And then the last, maybe the last point on this pillar of project evaluation and selection that we have changed is adding some elements about, I would say, an encouragement for the issuer to specify, how is it drafted? I'm looking at it, I don't know it by heart yet, but to look at the environmental and social risks that are associated to the project. I think it's a contribution of the green bond principle of the market view to the do no significant harm debate that is hot in Europe. In fact, this is a lot debated in Europe and sometimes not understood elsewhere in the world. So in fact, this is here the balanced view of the market on how it should be applied, how it can be applied globally, and what we encourage issuers to do. And I think this is good that those texts are bridging the gap between them, and so that's a very interesting development from my think. So I think, as a conclusion, no big change for most of the issuers, just a recognition of what is already done in the market. It's globally an increase in the level of transparency and accountability that is asked by the principle, which is a good thing. Remember that beyond the bond market, green bond principles are a source of inspiration or a reference for other financial instruments elsewhere. If you look at what is done on the loan market, on the swap market, on other financial instruments, green bond principles are the reference. So it was important that we adapt this reference text so that it can keep on being the Bible for all sustainable finance instruments. Over to you, Niklas.
Thank you very much, Tanguy. Again, Denise, Jonah, do you want to comment further, or should we move on?
I'd like to add something. I think just, to buffer what Tanguy said, we often take for granted, you know, and we talk about issuers who are already doing some of these things, but the size that we are at in this market, whilst it's incredibly impressive, given where we've come from, it's still a long way to go. And so that means bringing in many, many more issuers who are not yet at this party. And what we're doing is making it very clear to some of those issuers. I mean, at IFC, a huge part of our work is promoting the sustainable bond market through capacity building. And so we see firsthand in emerging markets the kind of questions that issuers are asking about how to come to markets with these products. And so I think that we shouldn't take it for granted that there's certain things that are clear to us and obvious need to be done. And you know, the best practices we're seeing, I would argue, are the peak and the fringe of the market at the moment. And what we're trying to do is to bring that down, to drill it all the way to the bottom, which is those who are coming up, by making clear what the pillars are and the key recommendations for best practices.
Thank you, Denise. I'll turn to, actually, I'll stay with you, Denise. You know, we talk a lot about the GBP, but we've got very other important sets of principles, social bond principles, sustainability bond guidelines. Were they updated differently? Was there additional guidance for these instruments and these principles this year?
Yeah, I mean, you know how, obviously, having been the chair of the social bond working group, I'm a champion of social bonds, and I've often referred to it as the Cinderella of the products. But the ball happened, and this was unfortunately the pandemic. But some historical context, I mean, in the summer of 2017, when we put out the first version of the SBP, that was obviously a milestone for the market, and the combination of the work that the working group did, which was at the time, I think, the largest one under the principles. But since then, as I said earlier, we updated the principles in 2018. And then last year, at which point the GBP obviously was left untouched. But those changes were incredibly fundamental because of the challenges that we saw. We this year saw an extensive review by the executive committee and the working group that the principles remain effective as they currently are. Hence, the changes were only to be consistent with the 2021 edition of the Green Bond Principles. And so similar to the updates in the principles that I covered, the SBP and the sustainability bond guidelines mirror the updates that Tanguy just mentioned in the Green Bond Principles. So I think the executive committee and the steering work remarkably hard on ensuring that any changes that are brought to the entire family of these the principles have global applicability. Joanna spoke to that as well. And we also see, of course, the moves that are being made by stakeholders that surround this market. And that move is what called for this heightened disclosure that Tanguy explains very eloquently. And just back to the last point I would make is that, so back to the what Tanguy had also mentioned, which was what was the spirit when the principles were created. And that was really to provide market guidance on 3 levels. The first being, well, what are the key components involved in launching, a sustainable bond? The second is how, what can you provide investors? What kind of information should investors have to help them evaluate these bonds? And then the third, obviously, to help underwriters to facilitate the transactions. So that remains, as I said earlier, the barometer. And we did the same for the SBP this year. And based on that, the only changes that were made were those to keep it consistent with the principles. So I hope that answers your question. It
does, thank you. We haven't talked about sustainability-linked bonds yet, and I want to turn to Tanguy, and Tanguy, you may have to unmute yourself again. And my question, Tanguy, is what is this new guidance for sustainability-linked bonds? Referring to KPIs, and then are we planning also to update the SLBP? I mean, we brought them out last year, but is there an imminent update?
No, we do not change the SLBPs this year. I think this is a new development that was done, as you know, last year and took us a lot of time. And I think I would like to underline here the success that is also to some extent linked to the green bond principle. It's not only linked to the green bond principle. I think the green bond principle has played a role. If you think about it, I mean, the SRBP, they were published in the spring last year, at the moment where the market was coping with COVID crisis, and then in the fall we saw the emergence of this asset class where we see now trades on a weekly basis. And I would also link the fact that we have seen this flurry of issuance to the fact that the principal have been addicted, and an issuer could know what are the best market practices that are recognized by everyone. What we have done this year and what the working group has done this year, and I really, and that's as always the fruit of a strong work by a very dedicated working group, and so on. Is a publication of a selection of KPIs, which in no way provides a comprehensive list of the KPIs that should be used in SLBPs, but provides some ideas about what is feasible on the one side, what is expected in terms of the specificities of the KPIs, the type of environmental and social challenges that need to be addressed, and also I would say by the diversity of the example that is given, give some ideas to an underwriter, issuer about what can be done in this market, what is expected, but also what is feasible in terms of innovation. We still need some still this market to keep on testing what is advisable, what is accepted by investors and by other market stakeholders. I think we're only at the first phase of the SLBP market. We are testing right now the market as we see new trades coming, as I said, on a weekly basis. And we are facing a question, a huge question that is clearly looming when we see the comments on those trades, which is what is ambitious, what is relevant for a given issuer, what is the relevant KPI, and what is ambitious. And it's even a more difficult and fascinating and exciting question than what is green, because in fact, if we want to manage the transition to a more environmentally, socially friendly economy, we need to be ambitious and we need to be relevant. But those questions, what is the relevant KPI, is something on which we will have to work collectively, not only the market consistencies, but also the market observers in the coming years. And in fact, the publication that we have done here for me is just one first brick to this debate. Here are the KPIs that we think at the Green Bond Principle may make sense in a number of backdrops, sometimes in association between some other KPIs. What is feasible? What is the level of detail that we expect? So not a big change in the SLBP. I would not say that at the Green Bond Principle in the XCOM or in the working group, we have not discussed about making big updates right now to this text. We think that we have something that really help, allow us to keep on growing the market and allow for innovation. But indeed, this debate about what is relevant and what is ambitious is going to occupy Wall Street for some years.
Thank you, Tanguy. I think what is ambition would be also a great question for a philosophy exam paper. But we will leave that for the moment. Tonguy's made some really interesting comments. Denise, Joanna, would you like to add?
I think some of the feedback that I've heard from some of the issuers that we work with in emerging markets has been how to determine what is material to, and so it's as you said, I think it's kind of a philosophical debate or question, but these are key matters that issuers need to understand to be able to, access this product. And I think that this publication we put out today does do that in the sense of putting out at least the step forward. It is not an evergreen document, and in fact, none of what we do is, because of course, as we said, we adapt to market developments. But I think it will certainly be welcomed by issuers that are, sort of in the dark as to where to even begin thinking about KPIs.
John, I was planning to turn to you, so I don't know if you want to start by also commenting, or should I jump to my next question?
And I think we've covered most of the ground, right? The questions are the same for investors. It's a new instrument, right? What is material, which KPIs should be expected or accepted. So I'm sure seeing a variety will truly also help. And then, of course, the rest of the discussion is also about the format of the change. So far, it's mostly been step ups, but we also see a step down. What is the size of that? Is the sizing material enough? Because we can see some harmonization around anchoring in basis points in the trades that have come so far. So this remains a really interesting market for, I think, all parts, of the constituency, and we'll be happy to monitor it grow and flourish.
Joanna, I'm going to stay with you, and so we've been talking, KPIs, sustainability, performance targets. Let's come back to impact reporting, which brings us back to the use of proceeds world. There's several deliverables this year. Is there a message? I mean, why are we being active on this front, or as active?
Because it's important, right? I mean, the purpose of the use of proceed markets is put proceeds to environmental or social or sustainable, which is when those interact. I've seen a question in the Q&A, how do the GVP and SVP interact? It's the same logic, but one, of course, look at green use of proceeds, the other look at social use of proceeds. We provide indicative categories, broad categories, and within that, we then advise to go into standards and taxonomies out there. And if you combine the two of them on purpose, that's when you go for a sustainability bond. That's how they interplay. And the important thing truly is what you do with the use of proceeds and then what happens. And it's the impact reporting that gives that ability to show, right? In the allocation report, you will see all the different projects that you actually spent the money, that you spent it for what it was intended for. Many issuers then also give something like an audit opinion that verifies that has happened. But the majority of issuers go further and report the actual impact. Now we have an immensely useful and dedicated working group that is our impact reporting working group that helps to harmonize the metrics that can be reported on. So on the green bond principles side, there are 10 broad categories that the green bonds speak about. They're indicative. They're also, not the only list that exists, but they've now managed to work through 9 out of those 10 categories to give much more deeper guidance on what that means and which metrics could be reported, and then also how that reporting could be harmonized. So the same kind of message and a comparable message comes across. And there's also a working group on the social side that does the same for the social categories. And since last year, since we talked, the Green Impact Working Group has covered climate change adaptation, and now the newest set. So climate change adaptation has been published earlier this year. We have working groups that work all year round, and whenever something is done, we kind of give it to you. We don't always need to wait for the annual general meeting of the principals or the conference, but it does coincide today that the Circular Economy and Eco-efficient Product chapter came out. And also from an investor perspective, there's more and more investors that view those sustainable bonds, especially the use of proceed ones, through an impact lens, through an impact investment lens. And many of us have started to actually collect the impact reported and start comparing it. And now with my Zurich hat on, we've done that for a couple of years, and it's an amazing experience to truly learn how you form those upfront hypotheses of how a use of proceed bond will change something, or how a company will move in their transition path, whether it's environmental or social, from one spot to another through using those proceeds to work on certain projects. It does give you a very good insight of what truly happens, and then how deep that impact is, and either in terms of unit per dollar invested, or also very many qualitative factors around it that put it into context. We have found out that many investors doing that started collecting and comparing in long lists and Excel sheets and their own databases. And of course, that's great as a use of concept and in bringing the market forward, but of course, that's not sustainable in and of itself. And luckily, as usual, data providers come to our help. So we've also seen a surge in data providers, not only reporting on issuance and the categories and the use of proceeds and market data, but now starting to pick up collecting impact reports for us. So we don't have to go through the PDFs and the newsletters of the many issuers that, and look at it, some of them have amazing reports out there. But they're very different. And if you want to aggregate, you want those harmonized metrics. You want to get that information in a very specific format. You might know some issuers issue bond by bond, and they report the impact bond by bond. Others issue a pool of bonds that will maintain a pool of projects, and then also report on those pools of projects, and investors process that information in a very specific way. So actually a substream of that impact working group has come together to now give guidance to data providers to say, if you really want to be of help to us, this is how you can be of best help. This is how you should, reference to the metrics that exist, look at certain specifications in how reporting should happen, analyzed, for example, and prorated, and so on and so forth, to really help bring the information and collection in a way that is most helpful. Also gives guidance to investors and issuers how to interact with the data providers, the existing ones, and then also the potential new ones. And at the Green Bond Principles, the principles in general, we have a bit of a tradition of allowing for self-highlighting. We've done that with external reviewers. We've done that actually with frameworks and with impact reports as well. And we will do that also for database issuers. So there's a template that went live today that will allow database providers to fill in that template and show who they are, that they exist in the first place, what they offer, and answer a variety of questions, which will then be collected on the webpage to then help give that additional guidance to the market of where information can be found if we're looking for it. And I think that's truly exciting because it'll bring us a big step forward, in my opinion, with the investor hat on.
Thank you, Joanna. We are about 5 more minutes on the panel. We're getting lots of questions. Some of them overlap. So I'm going to actually go with a last question, which I'll direct first to Denise. But please, Joanna and Tanguy, comment. But then we'll try to jump and cover at least some of the questions within roughly 10 minutes. So within the sort of 4 or 5 minutes we've got left, I wanted to ask you a sort of forward-looking question. I mean, where do we expect the market to go with the help of this guidance?
So, I mean, let's make no bones about it. There's a gargantuan task ahead of us if we are to achieve 2030. What we can do, I mean, there's policy and then there's practice. So this is where we feed into the practice side. The role that the bond market plays is just phenomenal. It cannot be underestimated in terms of channeling the financing needed to achieve all the sustainability goals. I think that the work we've done with these principles makes it more accessible to a wider range of issuers in terms of just the comprehension of the best practice standards. I think on what we're seeing in terms of the work we've done on the SLB side, again, I think that would be very welcomed also for the same reasons. So with that in mind, I do expect that there's changes that will be welcomed by the market, and being mindful, of course, to jurisdictional challenges and evolving regulation. We'd like to see, I do predict higher issuance. I think we already see that this year, but I think on the SLB side that we may and hopefully see some more S and G KPIs being used as opposed to climate, which has been the bulk of what we've seen so far. So I do think that there's a lot to expect, and I personally, similar to Tanguy and I think Joanna, are very optimistic on this.
Joanna, maybe, and then Tanguy.
Agreed. As optimistic as Denise, and I think the message is really, while we still welcome newcomers and a learning experience, there is a new, stick in the ground now what best practice means. And as Tanguy said, it won't change a lot for most issuers because that truly is the best practice today. We solidified it. But the message is also what we need is integrity, right? And because we work mainly through disclosure, it's very important to keep that in mind when coming to market, what best practice looks like and what good quality looks like, not only in disclosure, but then of course also in content. And I feel that's a good reminder to keep pointing the market in that direction.
Tanguy?
All that being said, I think, Nicolas, I think we can move to the question. Thank you.
Thank you, Tanguy. Very well. So I'm going to attempt to moderate the numerous questions that have come in, and very grateful for the level of interest here. As a preliminary, I would say many of the questions you're asking are already answered in the overall GBP or principles handbook. This is where we've got a thematic Q&A. We spent a lot of time on this. And there's a new edition which came out alongside the 2021 edition. So We're going to have a go now at answering your questions. The next panel will probably also try to pick up some of them, but please be aware you've got an overarching Q&A, which really is detailed, comprehensive, and that should be the Bible for a lot of these questions. Now, with respect to the Q&A today, one of the first questions is what are we actually saying about external reviews? You know, are we saying that there should be one, or are they saying should be two? And is it mandatory? Is that the message? And then there's a sort of subsidiary question again on external reviewers, which is, do we think external reviewers should become regulated? Who would like to start on this one?
I can start. I can start.
Okay, Denise will start.
Yes, so I think hopefully when you read the wording, you will see that it is not mandatory. However, it is a key recommendation. So basically the differences being that the four components, the pillars, as we call it, of the principles are what you need to be fully aligned. And then you've got the key recommendations, which are best practice. I think we are sensitive to the fact that there will always be this tension as to what we can do with a voluntary framework, as opposed to, you know, policing. And we believe that the addition of a framework and the external review are very positive, and investors have said that they want to see those things. Now, in the end, I think if you do have the four pillars adhered to and not one of those key recommendations, this is then where investors play a role. Do we think that external reviewers should be regulated? It is not the place of the principles to opine on such. However, I will say that we continue to engage extensively with this community, and there is work being done now, and that will be done over the next year with regards to external review best practices with the existing use of proceeds products, as well as, of course, the emerging sustainability links as well.
Thank you. I think a very interesting question on sustainability linked bonds, and actually several which intersect. And this is all about this question of the step up or the step down, and this question saying, well, you know, shouldn't it be fixed as a percentage rather than been set each time? There's a question saying, should it be set by third parties and not around the deal? So a lot of questions around this. Tanguy, do you want to start by taking that one?
I'm not sure. I am not sure I have understood your question. Sorry, can you?
Sorry. The question is around sustainability linked bonds and step up, step downs. Should we be giving guidance on the level, and also should there be a percentage, of a spread? Should a third party? The question interesting is that should a third party be setting the level, not the participants in the deal?
No, I think we're not. We're absolutely not there yet. And I think this is something on which we have spent a lot of time last year when we designed the SLBPs. And we, in fact, thought about this percentage, but in fact, it doesn't work. I mean, the array of possibilities that we have this market is huge. I mean, we can. There are issuers very highly rated with very small spread, and that will issue with, as well as high yield issuer with a very large spread. And so in fact 25 basis points for the first one may absolutely not be comparable to 25 basis points for the other one. If you think about percentage, I think there are issuers that may have a 4-year maturity, and others that may have a 40-year maturity, and then a percentage of the spread has completely different impact in terms of the total cost for the issuer. And so on and so forth. I mean, there are a number of considerations that makes it difficult for us, for the moment, and maybe also for the future, to restrict it more than what is done already. What is important at the end of the day, that it needs to be material. And I think this idea of materiality is something that all market participants, especially in the ESG space, they will understand. They understand what it means. And so we see when we see a trade, and we see that a number of very frequently, whether the step up or the impact on the bond characteristics is material for the issuer, or if it's a bit too small. And I think everybody is able to analyze that. And so I think for the moment, it would not be productive for the market. And also, because the market is very young and needs to have the possibility to innovate, it would be unproductive, I would say, to fix stricter limits.
I've got a follow-on for you, Joanna. I mean, as an investor, do you think that the SLB and the step up means that there's an incentive for the investor for the deal to fail, for the issuer to fail?
Ideally, no. I mean, we had those discussions a lot amongst the investors in the ExCom and the SLBP working group, also internally and with asset managers that we use. And that question often came, right? Wouldn't there be someone out there trying to game the system? The other question also came of how are you going to price that? And there is a real interesting difference in philosophy out there, because some are still trying to figure out, well, in reality, this is an option. How do we price that option? The other way of looking at it is that if you're an investor that is sustainable, of course, you want them to meet that. You want them to meet the target. And what the SLB gives you is skin in the game that's supposed to be material, and a certain framework that might actually go beyond the next management or strategy cycle. So ideally, it also gives you on a sustainability trajectory on which all of those issuers per definition are on different topics, but they are on a trajectory. It might give you the confidence as an investor that they have enough skin in the game that they will meet that target, even if management changes in between, even if the next strategy cycle comes along, which does give you a lot of confidence. And we also say that, you know, better ESG rating, more sustainability should actually lower risk. So accordingly, you know, the risk adjusted return for a more sustainable company is lower. So with that step up, that kind of also gives you additional guidance to then not necessarily have to price the issue difference, because it gives you additional forward-looking security to move the corporate, most of them are corporates today, into a lower risk sphere once they meet. Are there investors out there trying to play and ask for them to fail? There's no way to say no, but most investors interested in this market, because it is also a different mechanism. You don't buy that by accident, right? So if you buy it, that actually draws a lot of investors that have a vivid interest in what is happening and will buy the instrument for that reason. And I guess we have reason to believe that that's the majority.
So the investors are actually interested in the sustainability targets being met.
Yeah, if you're a sustainable investor, most of the time you
that's right
to the table because you have an interest.
Yeah,
you're not. And what that structure does is give you a variety of different points that can increase your hope that this will actually happen. Right.
Right. I think we got time for two more questions, and maybe starting with, well, actually the two maybe for Denise, and of course Joanna and Togi jump in. The first one, Denise, is there's some questions that are showing anxiety around the fact that we've actually updated these documents, and the anxiety is, if I can translate, is, well, are my previous deals being grandfathered or not? Do I have to immediately go out, rush and update my framework? What would be our feedback on that?
Just to be clear on that front, I would say fret not. If you were aligned with the principles prior, you remain so. I think we do have some language to that effect in the document itself, as well as in the guidance handbook, which I mentioned was updated as well today. So yeah, I was about to say it in French, but then I decided not a good idea because my French is not great. But yeah, so absolutely you're aligned still.
Very good. And look, a final question, which I think is very much for you. We've had questions on, well, shouldn't we have more sets of principles? And what about gender bond principles? Do we need a separate document?
Terrific question, because there is a lot of interest. There is no doubt that we see a lot of investors, who want exposure to gender projects, and this is the case at IFC. I think we come back to what the spirit of what we're trying to do here is, which is scale. And so to that point, when you look at the social bond principles, it caters to the need for gender. if there is a gap as to how social bonds can be applied for gender use, then that is a theme that can be looked at in terms of providing additional thematic material to support that. But I would say that we already have that covered. And as I mentioned earlier, our goal is consolidation as opposed to fragmentation of these products. We believe that, you know, the proliferation of labels is only confusing for the market, is at every point having to re-educate investors as to what a new label means. And what we have done here, I think the advantage of this community is that everything that we put out meets the smell test and the taste test, because you have the issuers there saying, okay, this is feasible. You have the underwriters who can obviously structure a transaction, and investors who say whether this is something they would buy. And so bear that in mind, that all these areas and angles are being looked at, so that when these documents and principles come out, be there whatever they may be called, the idea is that they are useful, not just beautiful documents and nobody ever uses. And so just to wrap up on that point, so once again, gender bonds, it sounds like a great idea. Yes, and it is already covered within the social bond principles, and it is an area of interest of the entire member and observer community.
Thank you very much, Denise. And as you say, it's a wider issue, and we try to make sure that the social bond principles, the green bond principles, are an umbrella where you can express all of these ESG themes and you can emphasize them in the marketing and, you know, in the discussion with investors. But the whole point is not to then go and fragment these umbrellas, which are given the market scale, depth, liquidity, etc. With that, I'm going to really thank Denise, Joanna, and Tanguy for their contribution to this panel. It's been great. And I'm now going to hand over to the next panel, and it is Joanna once again who will follow and take over as the moderator. Joanna, over to you.
Thank you, Nick. And well, again, hello to all the people we have on the line. I think we have almost 2,000 registered. If you just turned on Zoom to this, my name is Johanna Koop. I'm the vice chair of the Green Bond Principles and the head of responsible investment at Zurich Insurance. And I have with me today here a very distinguished panel who will speak with me and take where we just started, recapitulating of, you know, what is new, why we did it in the first place, and what we think it will do in the market, a little bit down into the realm of speaking to many of the experts that we have on the executive committee of the Green Bond Principles, and in their role in pushing best practice in their respective roles as issuers, underwriters, and investors in an everyday capacity. Now let's discuss what has happened in the market in the last year. And with me, and I'm going around in the order that I see panelists here on my screen, so it's completely random. I have Aniela Brusas, who's director at the funding and investor relations at Nordic Investment Bank. I have here for you Isabelle Dick Philippe, who's head of Euro Aggregate at Mundi. Roberto Fernandez Albendea, who's head of CSR and reputation at Iberdrola. Paul O'Connor, head of EMEA ESG debt capital markets at JP Morgan. And Kitish Pothalingam, who's an executive vice president and portfolio manager at PIMCO. Welcome, everyone. And let's get started. I mean, we haven't been at this conference for an entire year. A lot has happened in the market. And let's look a little bit at what has actually happened in the market. I will probably start with Paul. As an underwriter, you are, you know, in the first row and can visit what's happening. In the year, in all those developments, was there anything that surprised you in the green, social, and sustainability bond markets, or anything that really excited you?
Yes, thank you, and good afternoon to everybody. So, I mean, I think the most surprising thing for me was the pace of change. You know, the scale that the market has achieved in quite a short period of time. So we've seen, you know, a dramatic increase in issuance, and some of the statistics that Nicola presented earlier on, I think, you know, illustrate that. So pace of change, definitely. You know, another thing that surprised me is the participation or the desire to participate from all sectors of the economy. That was also, you know, quite a surprise. We had expected that ESG instruments would be used by the usual suspects, you know, kind of high footprint, high impact industry sectors, but we have seen, you know, interest all across the economy, I think, and that's also been quite noticeable. I've been speaking to people about ESG debt instruments that I had never expected to be speaking to about this subject. So that has certainly been a feature of the last year. In terms of exciting things, I think we have seen some landmark issuance, which is very significant. The any sustainability linked bond, for example, I think is pretty eye-catching. I think that is really important to open up the market and provide access for carbon-intensive issuers who have this almost sort of existential challenge to address. How can they evolve their business model, at the right pace? How can they deploy new technology? How do they finance all of this? And seeing that bond from any based on a very ambitious strategy, I think is a very important precedent, and hopefully that will open up the market for issuers who find themselves in a similar situation. So that was probably my highlight, I would say.
Thank you. Sounds like we're growing in breadth and depth and innovation capacity, which is of course something that we'd love to be supporting. Ketish, from an investor's perspective, same question. You see the same as just described?
So I think Paul's taken all my lines. So I think that the best way I would describe it is that the breadth of the market has meant that you need to be more and more aware of frameworks, and you need to be much more in tune with, say, what our issuers trying to achieve when they do some form of sustainable issuance. I think because of this, as the point raised by Paul, is that it's no longer just utilities, REITs and banks who are doing sustainable bonds. It's a whole other group of issues coming to the market as well. And then the other feature that I find interesting is that the number of conversations our credit analysts have with issuers is that what can we do to improve our sustainability outlook, effectively our business model. So when people talk about sustainability linked bonds, we've had a number of calls with issuers where they wish to hear from us what makes that impact in terms of us participating in that deal. And before, it was literally sort of, here is the menu, and you don't have much choice. Today, you have a lot of choice. But that doesn't imply that you then start saying, well, because I've got choice, I can go and do lots of different things. I think one needs to be disciplined. This idea of the update of the principles, in particular with regard to openness, that Denise in particular pushed this transparency, the need for frameworks, the need for external reviews, is reflecting in many respects the need from an investor's perspective for more market standardization. And I think that those are the things that say, and we're not going to discuss regulatory matters on this particular conversation, but it is worth noting that, say, central banks are now talking about regulation. There's a biennial test from the Bank of England. The EBA has launched its test as well. So these are other considerations as well. This has gone mainstream.
And is that a good thing? Is it standardized enough today?
Well, no, that's one of the things. So, but then you can't say, it's one of the things. So the best analogy is, why don't all cars have the same height bumpers, right? It seems to me an eminently sensible thing. It hasn't happened yet. We've been driving a lot longer than we've had sustainability issuance. So it's going to take time for the market uniformity to exist. You also don't want to discourage innovation either. If I turn around and say to Paul, you can't start talking to me about a different structure because it's not in keeping with what came before, he's going to say, well, what's the point of me being around, right? So I think you've got to balance this need for regulation and homogeneity with also the need for innovation as well.
And their transparency helps, which is why we make this the fundamental first step. I see you nod violently. Well, one of the big things last year, clearly, which we touched before in the previous panel, is that social bond has stopped being a Cinderella by going to the ball. I mean, this part of the market has really, really grown. Last year, we saw 162 billion of social bonds issued. This year, to date, already 113 billion. And that is multiples of all years together since the principles exist in 2017. So Isabel, as an investor, but specifically as a co-chair of the Social Bond Working Group, is this only due to COVID? Will this pass?
Thank you, Joanna. First, it's a pleasure for me to be in this panel and to have been involved in the Social Bond Working Group that has done tremendous work during the last 2 years under the impulse of Denise, especially. And I think that this tremendous work is echoing the dramatic market expansion. I don't think that the market expansion is only linked to the COVID-19. Of course, it has been a trigger, and it has pushed some issuers to go to that market with specific, let's say, financing of projects, and especially on the employment side and healthcare sector, for example. But I think that most issuers that went to the market would have gone to the market maybe a little afterwards. So strictly speaking, I think it's an impulse, and it's let's say the good phase of this horrible pandemic to have fostered the growth of the social bond market. One point I would like to mention also is because of that pandemic, we have had a new big issuer. So EU is now one of the biggest issuers on the social bond market, and I think it's very important because this instrument is now gaining another status. For me, it's like a new policy tool, and for EU, it's really, it will be very let's say a perfect instrument to report straightforwardly to investors, but also to citizens on the social part, but going forward on the green expenses of the next generation EU plan.
That's an interesting observation. So you're saying that supranationals, governments, sub-sovereigns, by using use of proceed instruments and then doing the impact reporting, that it's not only to investors, but that actually their constituency could read that and see what has happened.
Exactly. So I think it's really giving another status to this social bond of instrument.
That's an interesting take. And we saw a deliverable today on the social bond working group, right? A checklist that you feel that will help maintain pace in the market.
Yes, the work of the social bond working group this year was to foster, let's say, new issuers to come to the market. So the idea of this document was to pave the way for a new issuer, giving him all the different steps and all the different topics he has to address before issuing. So in terms of how to build its framework and how to approach the market. So really, it's a pragmatic document in which issuers, especially underwriters also, but also investors give all their, let's say, hints on what should be done before issuing a social bond. So very pragmatic, very practical document, and I hope it will help issuers to come to the market.
Wonderful. So all the things that we now have in the principles that you should do that, and we encourage you to do that, and you can do that, it's kind of listed, so you can walk through and build your framework.
So you can look through and you have reference to all the documents that are enclosed in the ICMA website. So very practical, and so no chance you miss one step. And especially there's also a section on second party opinion. So every topic is covered.
Well, speaking of frameworks, that's actually a good segue, because as we have said multiple times, we did ratchet up what is very strongly encouraged and by now actually seen as something that has to just be there, which is in various parts, the framework, linking to the sustainability strategy, the second party opinion, the impact reporting, that might sound like quite a hurdle. And we think we have two issuers here today who can speak about it. Maybe I start with Roberto at Iberdrola. Iberdrola has issued for a long time green bonds, one of the biggest corporate issuers out there. How hard is it to build such a framework? And the impact report, can you take us through that, share some of the challenges you had and whether you're happy you did it?
Sure, Joanna, thank you for the invitation. Well, first of all, we did our first issue back in April 2014. And it was a terrible week. Okay, I remember structuring the green side. I was at the time part of the investor relations team, and it was a little bit crazy. We did the second one, we did the third one, and after a year, we realized that we needed a process. We needed to make of it like an industrial process, okay? And we took the decision to write the framework because the framework would describe the process, the responsibilities, and how we would be doing things in the future. It took us several months to get to a paper. Then it took us several more months to get an agreement. But by mid-2016, I think around that date, we published the paper, okay? And it's been the best things we've ever done in this regard. The paper first recognizes that our framework was inspired in the Green Bond Principles with the 4 components. Very interestingly, at the time, back in 2016, we were adopting the 2 key recommendations that we are today publishing in the new GBPs because we had the framework and because we had a relevant chapter on external review. And I will talk about that later, okay? So the paper is good for us because it allowed us to build up this process. Now, every time we make an issue, we know who is responsible for assessing each of the different criteria we analyze for at project level and also at corporate level. Okay, so I think probably the most complex part of the framework for us was the selection criteria. We designed around 25 KPIs. Around half of those work at the corporate level, typically things about due diligence systems, procurements, policies, etc. And the rest of them work at project level. Things related, of course, CO2 emissions, biodiversity impacts, local controversies, etc. So we have these KPIs allocated to different teams within the company, and every time we go into to get a new issue, there's also a process. We have an inventory of potential assets to be allocated. We inform internally the assets that we're thinking of as eligible for the bond, and then all the process about checking, double checking whether the KPIs are fulfilled or not goes. Well, this seems to be simple. It was not simple back in 2016. Now it works very smoothly, and we live a better life. On verification, probably, well, before that, I think that was very good to create an internal culture around sustainability within the company. So for the financial team, that was not very natural 4 years ago. On the other side, the business divisions now live in a different way financial things because they were typically focused on building up new megawatts and finding pipeline, executing projects. Now they like to see that we get money for their projects, and they appreciate we get cheap money, so they feel a pretty bit involved in the financial and treasury things. And we are happy with it. On the verification, we self-imposed a very robust external review, which is, by the way, double. I think you need to go back in time. We didn't want to take any reputational risk, even knowing that we are financing easy assets, because wind farms, in principle, are very easy assets, but we didn't want to take any risk. So we have we self-imposed a ex-ante second-party opinion review, which analyzes that the portfolio of assets fulfills our selection criteria and is aligned with the taxonomy, specific taxonomy that we also designed. And ultimately also the issue is aligned with the Green Bond Principles. So that is ex ante. And then in an annual basis, we run a second review, which analyzes that for the issues that we've done during the year, we did a final allocation, or in the previous years, So that is kind of an allocation review. And it also verifies the impact reporting, which is not even a recommendation in the future European Green Bond Standard. So we verify ex ante the portfolio of assets, expose the allocation, and expose the impact reporting. And everything with the aim of providing investors the most robust potential framework and full comfort on the quality of our allocation. Of course, we report on a bond per bond basis, bond by bond basis. Yeah, sure.
Which is relatively unique, right? But I mean, as we have seen, and also now very specifically recognize in the principles, there are issues out there that report or that allocate bond per bond, and in your case also report bond per bond, and others that work more through a pooled approach. Maybe just quickly allowing the investors on the call to react to what Roberto just said. I mean, this is a very high level of transparency and verification. Is this something that investors value?
Yeah, I think the feedback we got very early in time is that people was very comfortable with our way of doing things. I remember a Swedish assurance company giving this kind of feedback. Not Swedish, sorry, Swiss.
Do any of the investors want to quickly comment to that? Shall we move on?
No, definitely, yes. It's very important to have such an alignment and such a degree of information from issuers, and definitely it's really what we are looking for in terms of best practices, to have this alignment at the company level and within the framework and the issuance, the allocation, and then afterwards the KPIs on the impact reporting. So definitely it's a plus, and this is something we really appreciate.
I definitely agree with Isabel on that. It's an analyst's nightmare to not have transparency, not to have that disclosure from issuers, and is to an extent to chase the issuers about disclosure is not easy because everyone's busy, and to an extent that if you are confident that you're buying into, first of all, I think one shouldn't regard a label as a reason to buy, right? So, and hence the quality of disclosure is one of the key measures, I think, that one needs when entering into any form of investment. But in particular with sustainability and the credibility associated with it, it has to have a rigorous disclosure.
Right, thank you. Well then, Aniela, we just looked at the corporate sector as a supranational Nordic investment bank. Of course, you work through a variety of topics and an entire region. So tell us your story.
Yes, so this is going to be another pro framework speech by a supranational. But I agree with Roberto. Every beginning is difficult. So even for a supranational with an explicit environmental mandate and being used to assess the environmental impact of the projects we finance, and especially when we now go back more than 10 years, when there were very little green bond issuance, guidance, best practice in place. So we did have very lengthy discussions, both internally and externally. And the first question was, of course, that are we convinced that the green bonds are going to stay, or is it a one-time off thing? And are we able to incorporate this into our long-term sustainable finance strategy? But we were convinced end of the day, and which turned out to be a very good decision, of course. So we published our first green framework and issued our first NIB environmental bond in 2011. Now, as a supranational with a green mandate, we naturally had a good platform to build on. We had the environmental projects, we had our own environmental analysts, and they had a ready process for how to evaluate and select the projects we're going to finance, and also how to report on it. But we also needed to decide then, should we choose just one or two of the eligible categories, for example, renewable energy and energy efficiency, or if we should allow several categories. And we chose the latter part. So we have 7 different categories today. and they look very much like the ones you see in the principles as well, in the green bond principles. So this means that when you buy a green bond from NIB, you will buy into a pool of projects belonging to then 7 different categories. And the only exception here is that when we have twice issued a Nordic Baltic blue bond, which is issued under the same framework, but here we then direct all the proceeds into projects only within the water management and protection, which our framework allows us to do. 10 years back, we also need to decide, whether we should consider all the environmental projects we have already, or if we should, be a little bit more tight and only choose the best of the best projects, so to say. So, where we estimate that there's a substantial, good, quantified environmental impact, and where the realization risk is very low. And again, we chose the latter. In addition, there was, of course, a number of other topics and technicalities to take into view. Should we just finance new projects, or would we consider refinancing? How should we separate the funds in our systems? How should we report? So there was a lot of things to consider, and it required a never before seen cross-departmental collaboration to get everybody comfortable with the framework. But that was very rewarding, to work with the different units, take a fresh look at our sustainability strategy overall, and then be able to communicate this to the market in the form of a framework. The structure of the framework document itself, that one is fairly easy. So 10 years back, it was, mostly about being transparent. Tell who we are, what we're going to do with the money, and how we're going to report on the impact. And then considering that, in 2014, when the Green Bond Principles published the 4 core components, it got even more easier to align yourself with those, and also structure and the layout of the framework in accordance with them. And today, luckily, and obviously, there's, of course, a lot of guidance, best practice, and a lot of good examples of how a framework can look like. And if you're interested, then just go to the Principles website, to the data source. Here you can find a variety of different frameworks, all aligned with the core components. So, a transparent, well-structured framework, it will help the investors like Ketish and Isabel. They will get the information they need. It's all collected in one place, and helps them to do their investment decision. And the framework, yes, it should include information about the bond issuance and the projects you're going to finance, but it also gives you an opportunity as an issuer to summarize your overall sustainability strategy. So a strong, or should I say, key recommendation from our side as well to go ahead and establish and use a framework. And there's no need to update the framework constantly. I think there was a question today also from the public. So, if you do no bigger changes to your framework, then you don't have to change it the whole time. But we had the same framework for many, many years. And then it wasn't until 2018 that we updated it, because there were some bigger changes to the content. And in that process, we also then acquired a new refreshed second opinion from the external reviewer.
Excellent. Well, that sounds like a great explanation of why so many issuers have frameworks, and so many of them that we actually now make it a very, very key recommendation. And thank you for answering some of the questions we're getting in the Q&A on the side. Little service tweet, you may keep sending them. We will have a look and monitor them on the side and see how we can answer them while we go. And it truly is the same, right? Once you have a second party opinion or framework or the impact report, you're required to update it whenever there are material changes, but otherwise you don't need to update things just for the sake of updating, like the principles themselves. I have seen questions around, and one big topic that we haven't really spoken about very much today yet is, of course, climate change transition. And there we do have the new climate transition finance handbook. And Paul also co-chairs this working group. Paul, what's happening in the climate transition space, and some of the public people have asked us, why is this a handbook and not principles? How does that fit into the overall universe? Maybe touch on that as well.
Sure, happy to. So first thing to say is there's a lot happening. So probably 80-90% of the dialogue I'm having at the moment with clients is on the subject of transition. Essentially, issuers who are in carbon intensive sectors wanting to show that they can evolve their business model and be resilient in a world where, the cost of being a carbon emitter is going up and up. So, the content of the handbook and the elements within it, I am using on a day-to-day basis. Talking about materiality, importance of the strategy, science-based targets, visibility of investments, et cetera. That is live, day in, day out. What I think has been a problem is the word transition and the idea of putting that on a bond and using it as a label. I think it's kind of a loaded word. And, some people have perceived that maybe it's a sort of a disguise or a way for people to kind of disingenuously access the ESG debt capital markets, and may have questionable motivations. So I think issuers tend to prefer, if they can do a green bond, which is still connected to a transition story, they would rather use the green label. If they can do a sustainability linked bond, which again communicates a credible transition strategy, that is another attractive option. But using the label transition, I think people are aware there are differing views in the market around that word, and there is a reluctance or reticence to use it. And maybe that's not a bad thing. One of the points being made is there's too many labels. Do we want to explain all over again what transition means versus, the other labels we've seen? So I think people understand that, idea of proliferation and why it may not be so helpful. That's part of the reason why it's a handbook and not principles. I think there was a recognition that we should stop short of introducing formally a new label, but that the concepts that are embedded within the handbook, they can sit under a different label that investors are more comfortable with and is, less divisive in the market. So I think that's largely the rationale why we have used the term handbook rather than formally trying to introduce, a new label for an ESG labeled debt instrument. Lastly, you could argue that introducing the handbook has been helpful in that, setting out that expectation has headed off some of the issuance that may have come if we hadn't have done that. And by setting the bar at a certain level, it has potentially protected the market to a certain extent from some sort of perceived contamination or something. Others will say, well, actually, we need to open up a transition label market. And I think, I haven't seen the debate move on too much from those original sort of starting points. And it's very much a feature of, where people sit in the investment system. But I think certainly in terms of the substance, as I say, day in, day out, we are certainly using all the concepts that, are embedded within the handbook. And I think that has been super, super helpful. There's an old adage in the banking industry, sometimes the best deal is the deal that you didn't do. And maybe that applies to, some of these transition bonds that may have come if we hadn't, gone down the road of issuing the handbook. But interested to hear, the views of others on the subject of transition.
That's a very interesting viewpoint. And the handbook does say, if you're on a climate change transition trajectory, which means Paris aligned, which means net zero, no matter where you start, this is how you communicate that strategy. And then you can link it both to the use of proceed tools, and then there the green or sustainability bond principles will give you more guidance on how to structure that.
Exactly.
Or link it with an SLBP, where then the target would be a transition linked KPI and a transition linked target. And that's how you structure that. So it's like Lego, you put them together.
Exactly. And I like this concept, of looking through the label. I think Ketish alluded to this earlier. That's what this is really about. The issuer needs to set out its proposition. The investor needs to understand it and challenge it as appropriate. And that's what's important. There's a little bit of a fixation on labels, which I understand, but ultimately this is about credibility and the credibility of the issuer's, proposition, as to how they are going to evolve their business model.
Yeah, and the word label now has come up so often in our discussions and in the commentary. We heard transition bond, transition label. Aniela, you said you had your framework covers 7 topics, and in your green bond framework, you once issued a maritime, a blue focused bond, but it was still a green bond, if I understood you correctly. And now, of course, before Denise got the question, why are there no gender bonds? And you said, well, technically gender is also social. So maybe let's ask first the investors, are more labels better?
The fewer, the better. I think the problem is that, say, it's a bit like single agenda approaches to anything, is that if you just look, I want a single agenda outcome, it sort of misses the generic move, if that makes sense, right? So the point of sustainability, I read a really good summary of it from an issuer who said sustainability in their view is trying to meet today's needs whilst not compromising the ability of the next generations that follows ability to meet their needs as well. And I think that to me sums it up perfectly. And in the concept of, say, transition, and to Paul's point, is that if you have a framework which you have already cited as we want to transition our business towards Paris alignment, you have enough instruments already in existence to do that. So, you know, if you have specific projects and you have a credible framework, you can issue a green bond. But also, we were keen sponsors of the idea of the SLBs from the perspective of this is an avenue for companies in different areas of the market to transition their businesses through general proceeds, and then effectively set themselves sufficiently credible KPIs and SPTs, which then make it credible that they are transitioning their business. And that to me makes the most sense. So you don't need a specific label to make yourself able to be transitioned.
I'm really on the same page. So the fewer the labels we have, the better it is. Already we are covering a lot of topics with the green, the social, and the sustainability bonds. And SLBs are complementing them on another way, because on one side you have use of proceeds, transparency, you know which project you are financing. On the other one, you can finance an issuer that want to put some milestones in its journey, a sustainable journey, either on the social or a mix of the two, or on the green side. So in terms of instruments, for us, it's highly sufficient. And we really advocate so that there's the 3 main labels remain. And if you want to have a specific topic under this umbrella, please do like Angela has done. So what we call, let's say, a sub-label, or give another name, but under your main umbrella, and really specify that it's under your green bond framework, green bond issuances or social issuances. And afterwards, you can specifically mention the main theme or the only specific theme of your bond if you want to.
Johanna, can I just shortly comment on that one? So the blue bond, let's blame the Swedes now, the real Swedes. So because this was actually an initiative from the Swedish investors. So I mean, the correct name of our blue bond is the Nordic Baltic Blue Bond. So all the projects that we are financing, they're actually helping to clean up and protect our Baltic Sea. And this was an initiative from the Swedish investors, and we were just happy, to include this one in the same framework. But I fully agree as well. We don't need more labeled, bonds, new names, but we can try to use what we already have in place.
Great. So a lot of color where you say you have your frameworks, and the important thing is to communicate, is it in according with the green social bond principles or sustainability linked bonds? And then you say this is a XYZ themed bond under the green bond principles or under the social bond principles. Sounds like that would be helpful to everyone. Another question I had is with Roberto and Jelena kind of telling us how true best practice looks, and us adjusting the level now at what many, many issuers do in terms of their transparency, the frameworks, and all the things we're asking for. Are we discouraging beginners? So speaking as an investor, we have seen frameworks that look a bit, you want to give them the benefit of doubt, and then they come up with an impact report that blows you away. Or seen issuers become better and better at what they do over time. Are we shutting those out now?
No, quality has a cost, and better things need to have a better price. So ultimately, I think that is a matter of it's a matter of there should be a minimum of disclosure, and I think that the green bond principles, as of now, they're a good proposal with 4 components and 2 key recommendations. I think if you ask me, I would have 6 components. But I know that, for reaching a wide consensus in the market and not to push the beginners, it's better to keep that in that way. But I think that the set of principles that we have put together, the green bonds, the sustainability bonds, sustainability linked bonds, social bonds, I think it's sufficient, and I think it sets they set a bunch of minimum requirements, and I think that they should be considered minimum requirements, because they are truly what is needed to get transparency on the use of funds or transparency in the transition, whatever strategy. And I think that has to be assumed. I mean, all of us, we need to assume many things, and in life. So if you want to have a green finance instrument, you need to assume certain things. Yeah, for me, that comes naturally.
Speak about minimum standards, quality.
Yeah, sure.
That's supposed to also ensure the integrity of the market, right?
Absolutely.
Absolutely, it's really a key point, the integrity of the market and the minimum level of disclosure, because as investors, we also have we are accountable to our end clients on what we invest in. So just all those bonds are self-labeled. Of course, they are compliant with the social bond or the green bond principles at minimum. But anytime we invest in a bond, we need to have sufficient information to find it into the framework. If we don't find it, we have to ask the issuer. And prior to the issuance, most of the time we are in contact with the issuer. So at the very beginning, it was easy because there were not a lot of issuers. And of course, we know a lot of them right now quite well. So we don't need to see them each time they issue a new bond. But definitely, we need to have sufficient disclosure and to follow up on each issuer closely before investing, because it's our duty to double check this integrity and transparency.
Yeah, I'd echo that as well. But also, hopefully Paul will agree with me, is that the market's now well versed in issuance, and lead managers arrange new borrowers very successfully. So they give access, and I think it's a guidance that I'm sure all lead managers give potentially new borrowers, especially borrowers who are trying to do a new instrument for them. Say, let's say the first green bond, or the first sustainability, or first social bond, whatever they're trying to issue, is that the arrangers will be well versed already in what it makes, because that deal needs to succeed, because it's hopefully not going to be the last time they come to the market in this format. And reputational risk is associated with that as well. So and again, it's all this thing about frameworks, and people may be getting bored of the word, but there is a reason why we like frameworks. Is it because it works? It gives some people reference points within which to move around. And as a result of it, if you say to a new borrower, well, if you have these are our minimum requirements, that's the point of a roadshow, and the point about them meeting the investors. And I think investors are now also well versed in what questions they need to ask. And this is one of the best things about, say, from I think it was Tanguy who said 2018 to where we are today, 3 years hence, the market has grown significantly, and there are much more borrowers. But and a lot of them are new borrowers, and they all now know how to do it because they've done it. If that makes sense.
Right, and there is a lot of guidance out there and a lot of expertise that helps to build those skill sets and checklists of how you can get there. But we've also heard this discussion in broader fora, especially for emerging market issuers, that also, of course, what is green and social enough depends very much on context and also on the geographic and regulatory context. Would you say, as investors that do so much due diligence, you have the capability to understand who is already a very high standard and keep them to a higher standard, and who is a beginner, and not let loose of minimum standards, but then also place them in the correct context so that they don't need to be scared to come to market because the understanding will be there?
I would say that if a company wishes to access the market, they have made it in a sustainable issuance, they have made a decision themselves already, right? So, and there's an established market. So if it was, let's say, not an established market, then you could understand that their initial steps are stuttering. But because there is precedent and there is guidance and there are, and most sectors have now issued, it shouldn't really be an enormous challenge to an issuer to do that. Now, do we have the wherewithal? Well, you know, like Isabel, operate in the luxury from a large firm. And I think this is more of a consideration for smaller investors, is that's why frameworks are so important. And that's why, say, this idea of people being disciplined in their disclosure is very important as well, because not all small investors can assess everything to the level of detail that, say, larger houses do. And I think it is the onus, to an extent, is on the issuer to make sure that their disclosure is clear.
Excellent. And I think you just mentioned one of the key reasons why we have also made the second party opinions a key recommendation, because they often help gauge and summarize for those smaller investors. Well, we have agreed that we will do a little bit of a fast shot last round, thinking that, of course, we all wish for the market to grow, to remain integer, and to actually reach its goal of moving money to fund a more sustainable future. So with your hats on as issuers, underwriters, and investors on respectively, if you could make one wish to the rest of the community to bring us forward on that journey, what would it be in a very short sentence? Maybe I will start off with Anila.
Well, for us as an issuer, our main challenge is actually to find enough of eligible assets for our green bonds. It might sound, peculiar, but that's the case. So I would just say, without getting into the regulators and all that if the various initiatives, they lead to clarity amongst, the market participants on what is acceptable, and, the potential customers and projects are able to compile the data required and report on their sustainability impacts and risks in a transparent way, it will perhaps, enable us better to assess whether we can support them on their journey. So I say something positive about the initiatives in the market.
Very good, thank you.
From my perspective, I think it's about investing in expertise. I think we need to invest in expertise to the point that we don't need to talk about ESG anymore. And the more understanding we have between the allocators of capital and the users of that capital, I think the less problems we'll have. So investing in expertise, I think, is key for me.
Thank you. Roberto.
I think that taxonomies are going to change it all. And at a certain point in time, everything will be sustainable or it won't be financeable. That is my hope.
Wonderful. Isabel?
So in the meantime, I think that we will need even more data and readily accessible data for investors, because we will have to comply with the new regulation, SFDR, and I think it will require more data from us, so from the issuers also. And I hope that we will get to a minimum standardization on that front.
I think it's in keeping with what all the others have said, is that I'd like to see more and more issuers commit to sustainability in their business models. And as a result of it, commit to that by putting it if they need debt, to have that as a conditionality attached to their debt issuance. And that would be, in one sentence.
Wonderful. So a lot to do, and messages out there to all the market participants of what they can do next. Of course, help the principles will remain there as a platform to help. With that, I think we're closing today's event. I would like to extend heartfelt thank you to the panelists who were there with us today and for all their insights. A lot of thanks to the large audience who has visited us today and been with us. Of course, the entire executive committee and all the many, many working groups, because it's due to them that all those updates were able to be produced in the first place and presented to the public today, and the Secretariat at ICMA that is helping us with a lot of capacity of kind of keeping everyone together, keeping us organized and doing a tremendous job in that. Today, specifically for this conference, of course, we had a sponsor, Nasdaq, thank you for that, and the ICMA event team that has helped us. And so, everything that is left to say today is keep joining the sustainable bond markets, keep up their transparency, their integrity. And of course, this was virtual, which made the event a lot larger and more inclusive, and it really reduced the CO2 footprint. But I think I'm not only speaking for myself, that we hope that next year will be in a more hybrid fashion where we can see some of you again. But until then, stay safe, stay happy, take care of yourselves, and stay sustainable. Goodbye, everyone.